All right. So we're looking at this question. Kunda and Sitwala Company is considering manufacturing special drill bits and other equipment for mining rigs. The proposed project is currently regarded as complementary to its other lines of business, and the company has certain expertise by virtue of its having a large mechanical engineering staff. Because of the large outlays required to get into the business, management is concerned that Kunda and Sitwala earn a proper return. Since the new venture is believed to be sufficiently different from the company's existing operations, management feels that a required rate of return other than the company's present one should be employed. Okay. So basically, in this first paragraph, there's no important information. All right. Yeah, some questions they come paragraphs like this, but find some certain paragraphs. There's no information that you need from there. Okay. The financial manager's staff has identified. Yes. Yes. Is someone. Is there a question? Okay. The financial manager's staff has identified several companies with capital structures similar to that of Kunda and Sitwal engaged in the manufacture and sale of mining drilling equipment whose common stocks are publicly traded. Over the last 5 years, the median average beta of these companies has been 1.28. The staff believes that 18% is a reasonable estimate of the average return on stocks in general for the foreseeable future, and the Treasury bills rate will be around 12%. In financing projects, Kunda and Sitwala uses 40% debt and 60% equity. The after-tax cost of debt is 18% and the corporate tax is 35%. Part A, compute the required rate of return over the project. All right, so colleagues, the required rate of return, was that's from the investor's perspective. Then the cost of capital from the company's perspective. Colleagues, when we say this term cost of capital, what do we understand by the word cost of capital? Madam Tabitha, when you hear the word cost of capital, what did you understand? Okay, don't worry. Don't worry. Mr. Aaron, okay, cost of capital in simple words is just cost of financing. Okay, colleagues, cost of financing. What type of financing is there? Debt financing and equity financing. All right. So we already have the after tax cost of debt. Okay? And we've got information here about an equity beta. We've got information about a risk free rate. Okay. And we've got also information on the average return on the markets. Okay. So this required rate of return for the project from the investor's perspective, the shareholders' perspective, because cost of equity is dealing with the shareholders. Remember, as a business, you need to raise money through equity financing, so you sell shares. Now, when you sell those shares, you what is you are going to owe those providers of capital dividends. Okay, So you can think of the dividend rate as the cost of equity financing. Okay. So this dividend rate is the required rate of return. Okay. From the shareholder's perspective. But from the company's perspective, it is their cost of equity. So we've got, since we've heard the word beta here, colleagues, do we remember this term, equity beta? I think most of you were with me in second year for financial management. Do we remember equity beta, Mr. Manasseh? Equity beta? You just remember the word. Yeah. From now on, Mr. Manasseh, please remember it, okay? Because once you graduate, you'll be people can come to you for investment ideas and advice. Yes, equity beta, colleagues, it's just a measure of risk, how risky a share is. Okay, how risky a share is in relation to the stock market. That is what equity beta is. How risky a share is in relation to stock market. All right. So remember, the stock market has got an equity beta of 1. Okay. Stock market has got an equity beta of 1. So if a company has an equity beta of, let's say, 2, it means this is a risky company. Okay. It is a risky company. But remember the name of the game in investing, colleagues. The more return that you need, the more risk you need to take on. It's similar to gambling. If you want to win big, you have to take a bigger risk by betting big. If you want to win small, you take a smaller risk by betting small. Even in the financial markets, if you want to make more returns, you have to take on risk, right? For example, let's say someone like Elon Musk, okay, when he was talking about making these solar cars, the people who invested in that, okay, they had faith that okay, these solar powered cars are the way forward. So we're going to take on this risk and invest in this venture here. And we've seen the solar cars are doing well for Elon Musk, right? Okay. So those people took on that risk, all right, and it paid off. Okay. Yes. So we already have our equity beta. These are average return on stocks. Okay, it's just saying that okay, like for example, if you say in the Lusaka Securities Exchange, the average return is maybe 18%. What it means is if you invest in any companies any companies in the Lusaka Securities Exchange, on average, expect to get a return of 18%. Okay. You- Some companies will offer 18.5, 19, 20, but the average return is 18%. Okay. Yes. And then this treasury bills rate, 12%. This is the risk-free rate. Okay. Risk-free because it's government who we are investing in. Right. So government, unlike businesses, because a business can make a profit or a loss. That's why there are bigger risks there. Right. Now government can never fail to pay you. So your return is guaranteed with government. Okay. Your return is certain. This risk-free rate is telling you your return is certain because there is no risk. Okay. Yes. So basically, we're using the capital asset pricing model to determine the cost of equity, which is also the required rate of return for the shareholders. Okay, so remember with CAPM, okay, cost of equity is the risk-free rate plus the equity beta, open brackets, the average return on the markets, RM, minus the risk-free rate. Do we remember this formula, colleagues? This must be a very familiar formula. Okay. After you wrote financial management, you told yourself, I'm not going to see this again. And you're surprised a year afterwards, you have seen it again. Okay. So, colleagues, this average return on the market minus the risk free rate is called the equity premium. Other books, I think you hear at market premium. Yes. What it is just telling you the extra return you get if you take on a risk. Okay. The extra return that you get if you take on a risk. Okay. Yes. So, colleagues, this is how we tabulate this. Risk-free rate 12%, equity beta 1.28, return on market 18%, risk-free rate 12%. 18% minus 12%, 6%. So what that is saying that you get 6% extra return if you choose to invest on risky securities. Okay, this is investing in the treasury bills, which offer a return of 12%. Okay, the treasury bills, the risk-free investments, offer a return of 12%. The average return on the market is 18%. So that 6% is just telling you the extra return you are getting for incurring risk. Okay. So 1.28 times 6, 7.68. 12% plus 7.68, 19.68%. Yes, colleagues, any questions? I will start. Mr. Manasseh, any questions? Okay, Madam Tabitha, any questions? Madam Ruth? Yes, Madam, in God we trust. Mhm. Okay, no, 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 no. It's not, that's there are no conditions when this has to be used, Madam. Yeah, these risk-free return on markets, equity betas, they can be of any values. Okay. Mhm. But remember this: the main concept of the capital asset pricing model is, please write this down. The main concept is the more risk that you incur, the more return. Okay. Basically, what we're saying in this formula is this: if you increase beta, this required rate of return or cost of equity is also going to increase. Okay. Yes. If you decrease this beta E, this required rate of return is also going to drop. So the more risk you take on, the more return that you get. The less risk, the less return. That's why if you invest in the treasury bills, you're getting 12% because there's no risk. But you invest in the stock market, you get 18% because there is risk. Yes. The more risk, the more return. Concept of capital asset pricing model. All right. We can go to part. Yes, if beta increases, the return increases. If beta drops, the return drops. Okay, madam. That's what I said. Is that okay, madam? Madam, are you there? Oh, okay. All right. Okay. Compute the weighted average cost of capital. So I remember this topic gave a lot of people nightmares, so I don't think you've forgotten about it. Colleagues, what is the definition? How can you define weighted average cost of capital in simple words? Not textbook words where you start saying wait this, that. No. We're saying if you're telling a layman, you're telling them about the weighted average cost of capital. How do you define it? Madam Precious, remember you got 100% in that test for weighted average cost of capital. Okay. You got 100%. So I hope you haven't forgotten. What is weighted average cost of capital? Mr. Kizito also heard you. Uh-huh. Yes, Mr. Manasseh. Yes, Mr. Manasseh. You can go ahead. Yes, you can put it like that. Although you can also put it another way. But thank you, Mr. Manasseh. I'll straighten up how you've said it. But yes, anybody else? Let's see who is here. Mr. Kizito, Madam Janet. Yeah. Okay, colleagues. This is the overall cost of financing. Okay, colleagues, the overall cost of financing. Okay, the way your grades are calculated. Okay, your grades are calculated using weightages. The exam carries the biggest weightage. Then assignments carry the next weightage. Assignments and I think assignments then tests. Okay, so it means basically your exam is the thing that is going to mostly affect your grade. Similar to what we're talking about, the weighted average cost of capital. We say the overall cost of financing. Okay. How we're getting this overall cost, we're weighting our sources of financing. Okay. We are seeing which source of financing are we using more between equity and debt financing. Okay. So whichever source of financing that you use more is going to affect your overall cost of financing. Okay. Then the other way you can also look at it is the minimum required rate of return that is going to make the providers of capital happy, the shareholders and the lenders. Okay, that weighted average cost of return, that's the minimum return that they would want, basic. Okay, so if you give them a return less than that, they're not going to be happy with you. You have to give them a return, that same return or a greater return. Okay, colleagues? Yes. So remember the formula for the weighted average cost of capital, WACC? Because this topic gave a lot of you nightmares. So I believe you need to remember the formula. Okay. Equity financing over equity financing plus debt financing. This is the weightage for equity. We're saying out of the total financing that you've got, okay, what percentage is equity financing? Okay. Multiplied by the cost of equity plus debt financing over equity financing plus debt financing. So this is the weightage of debt. You're saying out of your overall financing, what percent is debt multiplied by the after-tax cost of debt. Colleagues, do we remember what this 1 minus t represents? Because remember, if you have a nightmare of this topic here, obviously you still have some questions that you have about this topic. Right? So this 1 minus t, colleagues, what it's basically saying is this. When a company takes on debt, it pays lower taxes versus a company that doesn't take on debt financing. Okay? A company that takes on debt financing pays lower taxes. So since you're paying lower taxes, okay, it's like there's a tax saving that you have. Okay, colleagues? That's what that 1 minus t means. Okay? Because remember, that profit that is taxed, first you have to deduct the interest payments that you make. So when you deduct the interest payments from that profit, it means the amount that is being taxed to you is going to be lower. So, colleagues, we come back to the question and we say, okay, let's look at our information. In financing projects, Kunda Sitwala uses 40% debt, okay, and 60% equity. So we've got our weightages already. Okay. So, colleagues, when you see this type of question, smile, rejoice, and thank Jesus that you don't need to tabulate uh, this. Okay, it's given to you. Okay. Yes. So, equity, debt financing 40%, cost of debt 18%, equity financing 60%, cost of equity we tabulated was 19.68. So we come back to this formula here. Okay. Yes. What this VE is just the market value of equity. Even this E here, I forgot to say when I was just saying equity, it's we are talking about the market value of equity. When we say the market value of equity, it's just what is the value of the company's equity according to the stock exchange. All right. Market capitalization. All right. I think, did you learn about firm valuation in this course? How to value a firm, get the market value of equity and market value of debt. Okay, market value of equity is just the number of shares times the share price. That will tell you the value of equity for the firm. Okay. The market value of debt, you just find out, okay, the debt that this company has issued out, the corporate bonds. We're talking about corporate bonds here, colleagues, multiplied by the market price of those corporate bonds. So the number of corporate bonds multiplied by the market price of the corporate bonds will give you the market value of debt. Okay, so goodness in this question, all of this has been done for you, and we got out the weightage of equity is 60%, cost of equity that 19.68, we put it here 0.1968, plus the weightage of debt 40%, multiplied by the after-tax cost of debt 18%, which is 0.18. Okay, you do your tabulation. 60% of 0.1968, 11.86. 40% times 0.18, 7.2. 11.86 plus 7.2, 19.07%. So the providers of finance for this Kunda company are only going to be happy with returns over 19% and over. If this company gives them a return of less than 19%, they will lose those providers of capital. Any questions, colleagues? Madam, in God, we trust. Any questions? Madam Joyce? Oh, okay. Yes. Wonderful. I'm happy. Madam Joyce? Now following means a lot of things. Because you can be confused and still following. Did you know that, colleagues? You can still be confused, but you're still following. But it means you have grasped something, but it just needs some areas to address. Okay, whenever you have a question, always feel free. Madam Jean, any questions? Uh-huh. Yes, 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 yes. Majority of times, yes. Because also the required rate of return can also refer also to debt. Yeah. Re- The required rate of return is always from the investor's perspective. Then it's a cost of equity of cost of debt from the company's perspective. All right. Anybody else? Part B, outline the concept of capital asset pricing model and explain the meaning of beta in relation to investments. So they will say the concept, the more risk that you take on, the more return that you're going to get. The less risk that you take on, the less return you're going to get. That is the main concept of this capital asset pricing model here. Okay. And it's expressed through the formula. All right. Because if we can see earlier on, let me just use this as an example. If we, let's say, for example, if we increased the beta from 1.28 to 2, this required rate of return was going to increase. And if we dropped this 1.28 below, let's say to 1 or 0.9, 0.8, our return would have dropped. Okay, colleagues? So I'm using capital asset pricing model estimates the required return on an investment based on its risk beta relative to the market. Okay. Beta, equity beta, measures how risky a stock or investment is relative to the overall market. All right. So I said earlier on, the market's beta is 1. Okay. So if the equity beta of a stock or an investment is greater than 1, then you know it's more risk in relation to the market. It's more risky than the other uh, investments in the market. Okay. It's more volatile. Okay. If the equity beta is less than 1, then it's less risk in relation to the market. Right. So as an investor, this equity beta it will tell you how risky that stock you're investing in is. Remember, as an investor, you can be a conservative investment, someone who doesn't want to take a lot of risk. So you would go for stocks or investments with betas which are equal to 1 or less than 1. Okay. But if you're a risk taker, someone who wants to make big profits, all right, you want to take leaps of faith. All right. A company has come up with a new invention or researched or developed something new, and you have faith that that new product or that new invention they've made is going to make profits. You're willing to take the risk. Okay? Yes. Yes. So basically, yeah, that's the question. That's co- concept of capital asset pricing model: more risk, more return. Low risk, less return. Meaning of beta: how risky the stock or an investment is in relation to the stock market. Yes. Mm-hmm. Systematic risk. Systematic risk, madam. You cannot. It's part C. It's part C. So we're coming to that. So you're a prophet, madam. You already prophesied that this is coming. You prophesied, madam. Madam who? That was Madam who? So we'll call you Prophet Jean from now on. Explain the implications of systematic and unsystematic risk for an investment. So systematic risk affects the whole entire market, okay, or the economy, all right? Systematic risk or market risk affects the entire stock market or the economy. All right. It doesn't, it's not industry specific. And systematic risk is the one that is industry specific. Okay. For example, can only be in the agricultural industry, can only be in the technological industry, can only be in the construction industry. That's unsystematic. But systematic, it covers the whole all industries. Okay. So examples of systematic risks, right? Recessions. Okay, when an economy faces a recession, a lot of sectors of the economy get affected. It's not one sector. Okay, so when there is a recession, you're going to find the agricultural sector is affected, the manufacturing sector is affected, construction sector is affected. All right. Interest rate hikes. When the Bank of Zambia increases the rate of borrowing, okay, it's going to affect all industries. It's not going to affect just one industry. It's going to affect majority industries. Wars or political crisis. All right. When there is a war, no one is going to be working colleagues. Okay. No one is going to be working. People are going to be trying to save their lives. So a lot of industries or sectors of the economy will be affected. Okay. Pandemics, COVID 19. Okay. They affected a lot of industries or sectors of the market. Okay. Even inflation. All right. Yes. The rate at which money loses its purchasing power is going to affect all industries. So, as an investment analyst and a portfolio manager, you should know that even though you try to diversify your portfolio, invest in agriculture, construction, IT, you cannot eliminate systematic risk. Any questions on systematic risk before we go to unsystematic risk? Uh-huh. Yes, madam. Systematic risk, madam, affects the entire economy. And systematic risk is industry specific. Doesn't affect the economy. Oh, that's kind of mute your mic, madam. Yes. And systematic risk, um, it's industry specific. It doesn't affect the economy. All right. Yes. So on systematic risks, company scandals, okay, product failures, factory fire or cyber attack. Okay, these risks, you just find just one company within one sector, bad management decisions. Okay, yes. These risks won't affect every company in the stock market. It won't affect the economy. So this is the risk which you can diversify out. You can diversify by investing in different sectors. Okay. Yes. Because there are risks which are only faced in the agricultural sector. Maybe like, for example, is where you have locusts, droughts. Okay. There are also risks that will only affect the technological sector. Yeah. There are also risks that will affect the energy sector. Okay. There are risks which are inherent in these sectors. So As a professional investor, you will know that okay, I cannot make my portfolio based on in the agricultural sector. I only buy shares in agricultural companies. And that's putting all your eggs in one basket. You want to invest in various sectors, all right? So that if the agricultural sector is hit, at least you make profits from the manufacturing sector, the energy sector. Yes, colleagues. Any questions? Okay, okay. Don't worry, madam. These notes are coming to you. I was just putting them properly. These are coming to you. Okay. These notes are coming to you. But I'm happy also taking the notes. Okay. Yes. Now, colleagues, the capital asset pricing model, which type of risk does it deal with? Systematic or unsystematic? But that might be multiple choice. Capital asset pricing model deals with which type of risk? And they ask you systematic risk. And since you also take risk management, you should be colleagues. You yes, you take risk management. So on the issue of risks, I should be hearing a lot of comments. So CAPM deals with systematic risk. Okay, capital asset pricing model deals